I calculated the intrinsic value of every major company in the S&P 500 to see if the market is actually under or overvalued. Here's how. First, I performed a deeply complex, incredibly thorough investigation into each business, analyzing their current standing, hidden risks, and what the market actually expects. Let's take NVIDIA as an example. NVIDIA currently trades near $225, rebounding over 35% from its spring lows. They just posted an $81.6 billion quarter, up 85% year over year, while scaling their Blackwell architecture to satisfy relentless enterprise demand. Right now, NVIDIA controls roughly 75 to 80% of the data center AI accelerator market, which sounds unbeatable until you look at the risks. First, NVIDIA doesn't fabricate its own chips, meaning heavy dependency on TSMC.
Yeah.
What's at the top of your list in terms of risk assessment?
The things that are hard for us, that are new for us, are geopolitical risk.
Yeah.
And it's out of our control. The best thing that we could do is just inform.
Second, competition is waking up. AMD's Instinct accelerators and open source software stacks are targeting cost-competitive inference.
Well, there's a lot of technology risk, and there's a lot of product design risk. There's a lot of those kind of things.
And third, big tech hyperscalers will eventually enter a capital expenditure digestion cycle.
We published a paper recently out of the Goldman Sachs Global Institute that talked about the scale of this investment and just how high the bar will be, how high the hill is that we have to climb to generate sufficient payback.
Spending a small country's GDP on infrastructure every quarter has limits. Today, in this hypergrowth phase, NVIDIA carries a volatile beta, translating to an 8% cost of capital. But as tech giants mature, that risk naturally compresses toward the market average, bringing our discount rate down toward 4%. With annual free cash flow scaling past $200 billion. In years 1 through 3, we model elevated annual growth between 35 and 50%. In years 4 through 10, gravity kicks in. Growth naturally decelerates to 12 to 18% as base effects compound and data center capacity normalizes. From there, growth linearly fades down to a terminal rate of 2.5%. Based on these assumptions, NVIDIA's intrinsic value comes out to $329.40. That's roughly 46% above its current price, signaling substantial upside for the stock. I then applied this exact valuation model across every major stock in the S&P 500, allowing us to calculate a fair value for the entire index. Surprisingly, despite the widespread perception that the market is severely overstretched, our aggregate model reveals an overvaluation of just 3 to 4%. That is virtually negligible, suggesting the broader market is actually reasonably efficient. But there is a major catch: extreme top-heavy concentration. AI infrastructure, hyperscalers, and semiconductor giants alone make up a staggering 69% of the total index weight. This is precisely why AI bubble concerns are mounting in the US, whereas European benchmarks, like the Stoxx 600, exhibit a much more balanced macroeconomic profile. Any realistic risk assessment of the S&P 500 hinges entirely on this tech cohort. They don't just hold the heaviest weight, they also carry the highest expectations, with consensus projecting 20 to 50% annual growth over the next 2 to 5 years, and 10% growth extending to year 10. Our baseline valuation priced in those exact expectations. But what happens if reality falls short? How far would the index actually tank? To find out, let's stress test the basket by scaling these tech leaders down to a more conservative 10 to 20% growth over the next 2 to 5 years, fading to 8% through year 10. Under these revised assumptions, the S&P 500 is overvalued by roughly 16%. That points to a standard market correction rather than a catastrophic bubble burst. The index still maintains meaningful diversification outside of tech, though adding global market exposure remains a prudent way to manage downside risk. So, are we safe? If you're fearing a sudden collapse like the year 2000 dot-com crash, the answer is yes. But if you're looking across the broader macroeconomic landscape, the answer is not necessarily. Several hidden pressure points continue to build behind the scenes. Sovereign debt and fiscal strain, Record peacetime deficits across the US, Europe, and Japan, combined with central bank quantitative tightening, are pushing bond yields higher and leaving governments with minimal fiscal room to cushion a recession. Geoeconomic fragmentation, expanding tariffs, technology export controls, and regional conflict choke points threaten global supply chains and risk keeping inflation sticky. Policy divergence, such as the Bank of Japan hiking rates, can trigger sudden, violent unwinds of global currency carry trades. Ultra-tight corporate bond spreads leave zero margin for error if earnings deteriorate or debt refinancing fails. Yet the future isn't purely defined by downside risks. If artificial intelligence fulfills its potential, it could unleash an unprecedented wave of structural productivity across the global economy.
I think we're headed for an age of amazing abundance. So this is, I guess, a message of optimism and excitement about the future.
Which brings us to the great economic paradox of technological revolutions. Massive productivity explosions almost never reward the companies building the infrastructure. In the 1840s, railroads fundamentally reorganized global trade and unlocked unimaginable wealth. Yet almost every early rail operator went bankrupt. Laying tracks is ruinously capital-intensive, and running trains eventually becomes a commoditized race to the bottom. In the late 1990s, telecom companies incinerated trillions of dollars, laying millions of miles of dark fiber optic cables across the globe. That infrastructure made the modern digital economy possible. It changed human civilization. The telecom companies that built it, most of them went to zero. Right now, the market is pricing this cycle as if the infrastructure layer will permanently capture every single dollar of economic surplus generated by artificial intelligence. Except economic surplus rarely stays where it is born. As open-source models rapidly close the capability gap, foundational models risk turning into a cheap commodity. Meanwhile, the tech giants are left holding massive depreciation bills on data centers that need multi-billion-dollar hardware upgrades every 4 years. So who actually captures the margin? The ultimate financial winners of the AI boom won't necessarily be the ones spending $40 billion a quarter on liquid-cooled server racks. It will be the century-old insurance conglomerates using autonomous agents to eliminate 30% of back-office overhead, or established enterprises that simply plug AI into an existing customer base to expand margins overnight. In a world where the return on capital increasingly outpaces traditional labor, owning high-quality, productive assets is more essential than ever.